What is the best Forex trading indicator? Well, in today's video, I'm going to give you my thought on that, and I'm going to be sharing with you an indicator that is, honestly, it's like low-key underrated. It is a super valuable tool that not a lot of people use. I use it on my charts all the time. I always have it there, and it goes into almost every single one of my trades. The indicator that I am talking about today is the ATR. Have you heard of it? Well, it stands for average true range, and I think is probably one of the most important tools to consider when trading Forex, and most people don't even know what it is. So let's give it a brief explanation, and then I'm going to show you guys the charts. I'm going to show you some examples, and we're going to talk about how you could use it in your Forex trading, or at least you can sort of test it and look through it yourself. Okay, so the average true range essentially takes a set number of bars. If you're using a 7 period, it looks back 7 periods. If you're using a 14, it goes back 14 bars or candles, and it basically calculates the average range of a bar during that time. So if you're looking back 7, let's say we're looking at a daily chart and we look back 7 periods, it's going to track over the last 7 days what the average range of motion for a candle is during that time from open to close. The reason that that is so important is because it has a huge advantage when dealing with stop loss placement. Now, it's not like a magical entry and exit indicator or anything like that. The average true range helps you with one of the most important components to Forex trading, which is risk management. And better stop losses mean the most. Have you ever heard the saying, a dollar saved is a dollar gained? Well, it comes down to it in Forex that a lot of times better stop losses and placing things out of the way just enough to avoid getting your stop loss hit could make the difference between profitability and being negative. So the average true range is a huge tool for helping with that. So what I'm going to do is I'm going to jump over to the charts and I'm going to show you guys what it looks like, how you can add it to your charts, and how you can use it. So let's go ahead and jump over to the charts. Okay guys, so we're taking a look at the charts here. So let's talk about the ATR and sort of where we can use it, how we can use it in combination with our technical analysis or our trading in general. So this is the indicator down here. You can see at the bottom of the screen, we've got the ATR. I'm currently using a 14 period ATR. And if we just jump into the settings of this really quick, we can pull it up and talk about this. So there's really not too much. And again, simple is better in my opinion. So this stuff is fairly simple. So basically, all you do on TradingView is you can just go to indicators, type ATR, and add this one. Again, we're going to be using a 14 period. You can add some style if you want. I like the area. But technically, I guess you could use a line or whatever type of version you want. I actually like the histogram as well. So we'll go with the histogram because I think it's easier to see. Okay, so the histogram there at the bottom of the screen is telling us some very important information. And it's not telling us when to get in. It's not really an entry and exit indicator. What it is it is more of a risk management tool. So you can see that it's moving up and down and around and it's changing. Well, what is this variable actually calculating? Well, it is calculating the average pip movement per bar during this time. So when we're looking at this, you can see during this time, we had a lot more movement in the chart, right? Because of this big spike, the ATR is probably going to spike in that same time. You can see there it goes. It's moving higher. Now, what that means is that the market's volatility is sort of expanding. There's more movement in the chart at this time compared to a time when things were relatively low volatility, like right here. Check this out. During this time on the chart, the bars weren't moving very much at all. And so this is important information because if a market is moving quite a bit versus when it's not moving much at all, the stop loss placement is going to be very different. If you're trying to day trade, but your stop loss is much too large or much too small, it can be a problem and it can cause you to get whipped out of trades easier and it can cause you to take unnecessary losses. Okay, so let's look at another example. I want to find a spot. So here's another example of a time that the average true range was considered pretty high. So around this time, how would we use the tool? Well, we can see there's a lot of movement in the chart here. So if we're going to be placing a stop loss and the market is moving quite a lot, if you put a stop loss too close to price, it is much more likely to get hit, right? Because the market is moving quite a bit. Whereas if you place a stop loss during this time, you might place it a little bit closer to price because it's just not moving as much. understanding the different environments and level of volatility in the market can be a huge help in placing better stop losses. Okay, it also tells us what is normal for the market to be doing in terms of range right now. So we're looking at CAD Swiss here on the 1 hour chart. And then let's just say we wanted to take a trade here at this pullback. This is where the indicator comes into play. So let's say we want to buy this market and we just say, okay, well, it's pulling back to support. And let's say right around here, we wanted to buy into this market because of past resistance, turn support, pretty fair, straightforward break and retest sort of entry here on the Canadian dollar versus the Swiss franc. Well, this is where this indicator really shines. Now we come down here and we say, okay, well, what is our average movement for a single bar right now on the 1 hour chart on the Canadian dollar versus the Swiss franc? Well, there's our answer. Right now, the Canadian dollar versus the Swiss franc is moving on average, let's say 8 to 9 pips per hour. Not very much, right? Pretty low volatility. On the contrary, we can just really quick take a look at something like GBP, JPY, still a 1 hour chart, and check this out. Up to 19 to 20 pips per hour. So this is why a lot of times people also like to trade things with higher or lower volatility. Some people prefer the higher moving, you jump in, you catch a big move and you catch out or jump out. And some people like the slower moving ones because they get a chance to move a little bit slower with it. So let's go back to CAD Swiss just because we had a trade example. If we were looking at this, this is why it's not necessarily, in my opinion, the best idea to make your trades, your stop loss distance a fixed amount. Sometimes people say, oh, I always risk 20 pips. Well, when looking at the different markets, we have to respect the different personalities of different markets. CAD Swiss over here is an old lady, right? It moves slow. So we have to respect that. And so let's say we did take a trade here. We don't necessarily want to risk 20 pips or 30 pips because it can be a much, much bigger stop loss than necessary. So this tells us that, okay, the average range is probably 10 pips per bar. Let's just say 10 to be conservative. And let's say we did want to take this trade. So we went long here on the move. Let's say we went right here. Okay. The cool thing about this is that if we know that on average, the bar is moving about 10 pips, let's say 8 to 10 pips, right? Then we would probably want to put a stop loss depending on how long you want to hold it. If you're trying to say, if I'm wrong in the next hour or two, let me go ahead and close out. Maybe in that case, you place a stop loss distance that's what? 10 to 12 pips, maybe just outside of what we would expect in terms of a normal movement, right? We don't want to get whipped out on a normal movement. That's the whole point of this indicator, at least how I like to use it. I say, I don't want to get whipped out on just a normal move. 10 pips to the downside, okay, that's somewhat in the normal. That's a little bit stretching the normal move. But if it really starts going, if it goes 20 pips to the downside, that's probably going to tell me that I'm wrong. This is where it shines, is helping to find stop loss placements that make a bit more sense. So when I'm looking at this and it says, okay, 8 pips is normal. Okay, I'm going to give my trade 8 pips to move against me. But if it starts going more than that, probably going to want to get out of there. Now, it could be different. If I'm more of a swing trader and I say, well, if this thing moves against me for like 3 hours to 4 hours, I'm still fine with that because I want to hold this thing hopefully for a few weeks. That's my time frame. This is where the ATR, it shines again. So let's look at this. If we're going for 4 times 8, let me see if I can do my math right. That's 4 times 8 is 32, right? In that case, maybe we say, well, that's the normal expected. Let me just give it a bit more. That's what I like to do. Let's say I risk 35 pips. 35 pips, normal sort of range. And then of course you can do your standard thing. Let's say, whatever you go for in terms of reward, that's a different video. I've got plenty of videos on that if you want to look at targets and trailing stops and whatever you want to do. But the point here is this is all about stop placement. As a trader, the first question you got to answer for yourself, not for anybody else, not for not for fun. You got to answer for yourself. What are you going to do if you're wrong? How are you going to handle a time in the market where things are not going well versus what are you going to do when it's going right? Well, again, this ATR helps us answer that first question. It says, okay, we have a market here that is moving 8 pips per hour on average. Then I don't want to put my stop loss 5 pips away or 4 pips away. I want to be a little bit more conservative, right? Because if I'm too close to price, I'm going to probably get whipped out too easily. But if I put it too far away, I might be adding extra risk that I don't necessarily need to take, because at about 8 to 10 pips, If we zoom in here a little bit, at about 8 to 10 pips, that's where, in my view, where we're right or wrong. So if we're sitting here and we say, okay, well, if it moves much more than 8 pips, I would consider myself wrong in this situation. And that helps me trim up my risk a bit, cut out a little bit of the added, downside potential, and really optimize my stop loss placement. Now, this is not going to do it all for you with any indicator. It's not going to be perfect. I think you probably also need to consider structure, or consider whatever else you do for stop loss placement. For me, I like to look at, I find a general area of support like this, strong area like that, and I'm keeping my stop loss enough of a place away. Just looking at this quickly, I might put my stop more about 12 to 13 pips away. I try and get, a good zone of range of motion here for this level to be retested. So you can see we came down to this point, tagged a little bit into it, and then reverse. That would be ideally what I'm looking for on this trade, is for that to quickly rebound, otherwise get me out for a stop fairly quickly. Because if this thing starts to break out and things and volatility expands, this is where we don't want to be. We don't want to be in a situation where price goes against us and volatility is expanding, right? If CAD Swiss right now just has an explosion in volatility and things start going against me, I don't want to be holding on to that trade anymore. I want to be like, okay, you know what? I was wrong, and just jump out of that fairly quickly. Maybe I can find a chance to re-enter, but I'm going to go ahead and adjust here. Stopping out quickly also gives you a chance, in my view, to react to changing volatility. If volatility just explodes and I get stopped out very quickly because of, news or something's happening in the world, then I can readjust and place my next stop loss with a little bit more new information as to what the new volatility levels are. Again, the average true range is my favorite indicator for checking volatility and better stop loss placement. If you enjoyed this video, do me a favor, smash that like button down below. It's free to do, and it really does help the channel. So if you want to see more free trading content, I don't sell a course. I don't do anything like that. You get this stuff for free, and I make a little bit of ad revenue. So if that's fair to you, then make sure to subscribe to the channel and tune in again in the future for more free trading content. Have a great rest of your day. Happy trading, and we'll see you back in the next one. Hey guys, thanks so much for watching this video. If you enjoyed it, please remember to like the video down below, because if you don't, you're statistically 84.72% more likely to blow an account in the next 48 hours. Don't ask me how, don't ask me why, that's just facts. If you enjoyed that video and you want to see more free content here on YouTube, I'll be popping up some videos on the screen now. Go ahead and click anything that looks interesting to you, and thank you so much for supporting the channel.